Okay, so Foued asks the question. Some of you may disagree with me on this, but I kind of hinted as to why this is in the discussion I just made about a little while ago. We talked about implied volatility, the double-edged sword. Where we see high implied volatility, where markets are fluctuating. VIX is near the lowest it's been in a long, long time. This might be one of those times I might consider buying calls on the VIX Monday or Tuesday, as we used to do in the past, as a total market hedge for the bullish position or the leverage spread position portion of our portfolio. That you can see those discussions if you do a search on YouTube for stock or portfolio insurance, really. Those question relates to the double-edged sword aspect, meaning that uncertainty leads to higher implied volatility. Higher implied volatility means higher premium, but it also means that the stocks you're looking at with the higher implied volatility are going to have a tendency to fluctuate more in price. And Foued wants to know, do you think Iron Condors are best suited for uncertain markets? I'm going to say a direct and emphatic no. I'm sorry, Foued, that is my answer. I'm going to talk about why in a moment. The nature of the Iron Condor. It's a combination of a bull put credit spread on one side of the security combined with a bear call credit spread with the same expiration on the same security. Look at this profit and loss chart. We're going to look at a more in-depth profit and loss chart. But look at this profit and loss chart. This is the definition of a neutral strategy, a neutral position. We don't want the stock to really move more than 0.2, 0.3% one direction or the other if we're using weeklies. No more than 1% or 2% up or down using a monthly. It's the definition of I only want to do this in certain and stable markets, a melt-up market, like we saw, if I'm not mistaken, I think it was 2021, where the stock moves up, the market was moving up gradually 1 to 1.5% per month, then pulled back 0.8%. Gradually moved up 1, 1.5%, 1.8%, fell 0.7%. Gradually moved up. 2021, a nice calm move up with a little hiccup down. That's the best time. 2020, not the best time to do Iron Condors at all. You're losing on the downside where you would have lost on bull puts. Then the rocket back up, you're losing on the upside and having to roll the bear calls. You're getting slaughtered in both directions during uncertain market conditions. 2022, a lot of premium could have been had, absolutely. A lot of adjustments would have had to be done because you're getting violated on one side or the other with the constant market shifts. In general, when we look at an Iron Condor, you say you can only lose one direction or the other. Once you get into a trap of an uncertain market and the market starts to decline, and you start moving the Iron Condors down or moving the legs of your bear call or your bull put down in price, and then all of a sudden the market snaps back up, well, you lost on this side and you had to roll out 4, 5, or 6 months to get the premium back, and now the market starts to recover and you're losing on this side. You can actually lose twice once you start adjusting the position and making movements. Iron Condor is a definition of a neutral transaction where you don't want to see a lot of movement in the underlying security. This is why it's usually recommended that if you're trading Iron Condor positions to be quote unquote safe, as Bruce had mentioned, how can I be more safe with the naked put structures? To be more safe with the Iron Condors, you should probably only be doing them on broad-based indexes and ETFs. NDX, SPX, QQQ, SPY, maybe RUT or IWM. We know they're a little bit more volatile. Not doing the 2X ETFs or 3X ETFs that swing wildly. Are they going to have a better return if it works out for you? Yes. Is there a better expectancy that it's going to swing against you and not work out for you? Yes. Where's the trade-off? Okay. Implied volatility, once again, is a double-edged sword. We do have a presentation on that. I think it's even in the archives here. It's a really old one, but if I did that presentation again today, it'd be 90% the same content. Where are we? I know it's older. It's much older. Undervalued options, market sentiment review. I might just have to do a control F on this one, but it's okay. I thought I put it here. I don't think I put it. There it is. Implied volatility, a double-edged sword from 2014. Many investors say here things such as you can't trade without knowing implied volatility and only sell high IV. We break down the effects of implied volatility while showing what to look for and what to avoid. There is such a thing as, if something looks too good to be true, it probably is. Most of you have been taught that by the market, following these rules of, oh, you want to sell into the highest implied volatility if possible. No, you really don't. Not necessarily. I love the extra premium, but I don't love the lower expectancy of potential profit in those cases from the swings. But again, if I don't want to cut you short. We spent a lot of time for Bruce related to testing. And let's take a look here. I'm going to go to SPY. And I hope I still have this on this account, but let me just take a look. There's 3 months. I'm going to go year to date. And this little patch in here looks pretty uncertain, right? Had some movement up here, some stability, and then it crashed down. Oh, we're trying to recover. Oh, crash back down. Move back up, back up. So this section here, what are we looking at from February? Yeah, let's just call it the February to May. Now, I'm not going to do a weekly series. We're just going to do a general gauge. And if I'm not mistaken, I could have just gone in the back test, but I want to see if it's here first. There's our zero taste. That's a SPX 2-week Condors. I don't want to spend 3 months on that. Iron Condor adjusted. It must be on my actual account, not the webinar account. I'm pretty sure I had a monthly and a weekly SPY that was used for some examples. All right, we'll have to use the SPX 2-week out Condors. Let's go to backtest. Smart History Excel. And we're going to go, oh, I can't go back to February. Okay, so we're going to start in the earliest day we can in March. Now is the end of that time frame. Again, the webinar account, we only have 3 months of backtesting. SPX 2-week out Condors. I'm going to take a look at the criteria and discuss that as well. All right, so let's see what we've got here. I guess Iron Condors take a little bit longer when the history is loaded because it's looking at 2 separate tables. It's got to look at the bear call and the bull put and combine them together. Now, there's 400 potential trades that match our criteria. What are my criteria? 6 to 17 days out, 2 weeks out in time. At least 1% out of the money. That's it. Probability above the short put strike and the bull put of 80%. Probability below the short call of 80%. Probability between, theoretical probability of stock would be between both strike prices, so all 4 options expire worthless is 80%. I don't have any technicals in here because why? Because we're just looking at SPX. We've made that decision. I'm not looking at any other securities here. And this percent out of the money range, 45 to 55, I'm looking at equidistant, meaning that the short option is equidistant from the long. So these are 7 days out in time. Oh, this is a bad test to do. Let's change this. I'm sorry. So did I start March 20th? Yeah. You see why? I'm sorry. They're daily options. It's all the 7, 8s, and 9s. I want to isolate this a little bit more. I apologize. So let's just do that to, if I was opening on Monday, it'd be 5 days out. So let's just go 4, try to minimize it, 4 to 6 days out in time. Oh, I should do 3 to 6, shouldn't I? Eesh. 3 to 5. I'm going to do 3 to 5. All right. See if we get anything. And I'm pretty sure it's not money. Good. It's still 400, but they're all 4. All right. So let's just calculate group results. This might take a hot moment. And again, this is doing the weeklies of this time period of March 20th to March 24th. What we're seeing on March 20th to March 24th. Not some relative uncertainty, right? We're right about here. We've got a dip down and a move back, a significant move back up. And this isn't applying testing here. Okay, good. So those are all positive in the top results. And that's 50.3%. That's because we're being more aggressive. All right, here's what we're going to do. Instead of that, let's do something different. Instead of just SPX. Broad market, suited for uncertain markets. Rather than use that, let's just use the initial values. Actually, okay, I'll use weekly Iron Condors. My apologies. Let's see what we get here. Stocks that are more volatile. Let me see if the returns are reasonable. Yep, for an Iron Condor, probability is where I want it to be. This would have been March 20th. These are, this went to the monthly. This did go to the initial values. Okay, but that's fine. March 20th to April 21st expiration. It should have run March 20th. There we go. This will be faster anyway. Okay, so again, top 30. See some free names. Caterpillar, for solar. Coinbase, Snowflake, Costco, Deere, Airbnb. This is the monthly, remember, going from March 20th through April 21st, and we'll do April 21st to May, just as a gauge of broad stocks. The initial value search. You don't need to be looking at a bank screen. See some popular names there. Target at 163.24. I'm pretty sure that dropped during this time period. Not a lot. Not to 140, absolutely. Let's take a look. Yep. Okay, those worked out pretty well. 14.8% average return, 100% success rate. Now, next cycle. I'm on the wrong page. Next cycle. This was to April 21st. So now let's run the same initial values default screen, April 21st. What's not being shown there, by the way, I have to express that in just one moment to be clear. We'll take a look at it with this result, Foued. And these might be 100%. I'm not going to say that either. It's a more tame period, right? Now we're going from April 21st to now. We've had some hiccups here, but nothing extravagant. But we know some stocks may have probably hit. All right. Sorry about that. There we go. Ooh. Okay, so 30 results came in. Here's the top ones. A comment did come in and said, how are you showing the top 30 of 41 results, but only 4 appear? It's a second layer of sorting where we're only looking for one result per security. So the 41 total results are spread across these 4 stocks that match the criteria with different combinations. Okay, so for the percentage we want, the time frame, the probabilities, same margin on both sides of the spreads, beta less than 1.25, earnings not between now and expiration. And this was, remember, for the 30-day time period. So there are a lot of stocks that had, a lot of big stocks that had earnings from that time frame. So that's why you're only seeing 4 results. And why you're seeing top 30 of 41, all 41 are linked to these 4 stocks that match the criteria. And then that second sorting of only 1 result per security. Since I'm sorting by highest percentage return, it's showing me the highest percent return of the Iron Condors that met that other criteria on those 4 stocks. Enough of that babble. I should have left that babble for when this is running the screen here for the results. There we go. Perfect. Okay. All right. Okay, so you wouldn't have let this happen, Foued, but you see what we've got here. MDB took the full loss of 100%. At the time of the trade, we were selling the 170 put and buying the 260 call. The stock ended up at 275.18. Those big runs to the upside. Snowflake, 115 to 165. Stock ended up at 176.82. Yes, you wouldn't have taken 100% loss on the position. I know you would have tried to stop it, but if this wasn't earnings related, because we were avoiding stocks that had earnings between now and expiration, something you always want to do with an Iron Condor. So you had a good return in the first cycle, and then you have only a 50% win and a 43.8% loss. Plus, I doubt it happened, but let's take a look at Netflix here. Ended up at 365.36. It was only 11% return. Oh, because you had to pay to buy back the short call. So you didn't get the full net credit of 82 cents. You only got 36 cents in net credit. Didn't expire worthless. That's okay. It's still a profit. But one thing that's not showing here in this back test is, did the position hit a stop? Your short put strike price, 1%, and then the short put or short call strike price. The spread itself lost 40 or 50% well before it hit that 100% loss on the 19th. And it did hit a 54% loss where we would have looked to close the position. This shows you, yeah, it's just the day before that big dip. So the percent return would have been good. Down here, I'm looking at the stock price one. So it stayed reasonably within the range. It dipped down to about 320, but then started to come back up here. So you can see that as well, and the changes that are going in the trade. And then here's the first big loss where you would have taken a 54% loss only 2 days to expiration when you were still thinking you're at a near profit. The highest return was only 20% on 517. So you might have liquidated then, possibly. And it still was a profit at this time, but you definitely would have closed it here with that big drop the other day when you saw a 55.4% loss on the position 1 day before expiration if you're still holding it, had you not closed it at this point. Tough to gauge. This is giving you an idea of what's possible, and it's a very powerful tool to use. If you have questions, Foued, just like you do, you can save your search or your preferred search in the search tool for whatever strategy you want, link to the back test, and start running it. Now, of course, if you're on the trial, you have 3 months access. If you're a subscriber to Power Options, you have to be on the historical level of service at $100 per month or the premium level of service in order to get the full 6.5, 7 years of back testing available. Okay, so we show some of these, but raw definition. Are these good for uncertain markets? My opinion, no. This is a definition of a structure that you want certain and stable markets, even though that means the implied volatility is lower, and more boring. I'd rather see 85, 88, 90% success rate on my Iron Condors with a 10 or 11% return than see a 60, 65% win in uncertain fluctuating markets with a 20% return. The nature of the structure, the nature of the Iron Condor is to stay within that range. Yes, you can set the range out of the money that you want and the probability you want using those patented Power Options tools, just as I showed you for that default search I created, while still looking for the return that you want. But you still want to be in a stable to neutral market. And we kind of have been, the past several cycles, when we take a look at it. We haven't been fluctuating too much as we've seen definitely in the past 2 years and at the beginning of the year as well. So it might have been a good time, even though uncertainty is ahead. But to be honest with you, it feels now, doesn't it, that there's a lot less uncertainty ahead than where we thought we were 3 months ago, where we thought we were 6 months ago, where we thought we were 9 months ago. Things seem more stable now. The market sort of shrugged off this inflation. It hasn't shrugged off at home. It hasn't shrugged off out of our wallets. It hasn't shrugged off the grocery trips, but the market's kind of shrugged it off. They're digesting the concepts of less rate hikes or smaller rate hikes or no rate hikes going forward, maybe the next few cycles. It's brushing that off now. So it seems to be a little bit more stable, but knock on wood, the other news about the debt ceiling. Negotiators broke off the debt ceiling conversation here in the U.S. What does that mean for us heading into the first week of June in a couple weeks where it's supposed to run out of money, or the second week of June? I can't remember which it is. That's very big uncertainty. They'll get something done, but who's going to be happy about it, and is it going to work? That's a big one. When we still don't know the unexpected of what could happen over in Ukraine as well, and effect that would have on European global markets or anything else along those lines. So there is still uncertainty. It does feel less, doesn't it, Foued? But to answer your direct question, no. If I'm on uncertain markets, I'm not doing something like this. This is for a stable to neutral to melting up or melting down, slower movement down, slower movement up markets, melting up like we saw in 2021. Not something that I'd use consistently through time in, say, 2020 or 2022 or the end of 2018. Check out this chart for SPX, October or September to December of 2018. That was just a crazy wildness, almost akin to what we saw in 2022. If you look at the range and percentage that SPX moved down, back up, waffled in November, and then completely back down in December. So that was a time when I was buying out of the money strangles on SPY and QQQ. And as we hit a return peak, we just adjust it, the strangle up and down with those vast movements in those cases to take profits on buying a call and buying a put, and then just rebracketing that in uncertain markets. A little bit more expensive because volatility was higher, but that's what I wanted to see. Instead of having something that looked like this, I was hedging a portfolio on broad-based ETFs with something that looked like this. So on a long strangle position, buying it out of the money put, buying it out of the money call, See those wild swings that we saw in the time frames I'm talking about? You just re-bracket that, take the profit, re-bracket the strangle up, then it moves back down again. You know what? Going to re-bracket the strangle here. Short put at this price and up, go back up. Okay, re-bracket the strangle, taking the profits. And that's what I did in uncertain markets. I used it as a market hedge, not as a main portfolio driver. But it was to hedge other positions I had open, leverage trades, whether I was in credit spreads, bull or bear, and the stocks were fluctuating. I was going bull or bear with the technicals and what I wanted to see, not doing an Iron Condor, just hoping it wouldn't breach one or the other because it was consistently breaching one or the other. That's why I had the reverse strategy in place in that scenario. So those are my thoughts. Anyone has any counter thoughts? I'm always open to them. I'm not the best trader. I'm probably not even the best trader in the room right now. But this is not a strategy, in my opinion, for uncertain markets. Too much risk and too much potential to not hit the win target you need in fluctuating markets. Yes, premium looks better. You're taking advantage of implied volatility, but implied volatility is that double-edged sword. You've always got to keep that in mind. And you've always got to keep the structure of the trade in mind. Look at the profit and loss chart and say, without even thinking about the security, look at the profit and loss chart for the strategy. You're saying, what do I see when I see this? What is the very first thing that comes to mind? I have an upper and lower break even. I don't want the stock to get anywhere near 120 or 119, and I don't want the stock to get anywhere near 165, 168, or 169. I want it to stay right here. What kind of market conditions and what kind of stocks do you look for to make that happen? That's my answer to that question. And for any strategy, consider the graph first. Is Netflix good for this strategy? Well, what's your outlook for it? Now look at the strategy you're planning. Does the profit and loss chart match what your expectations are for the stock in the next 5 days, 2 weeks, 3 weeks, or a month? If it doesn't, then I'm going to say right away, no, it's not a good trade. Oh, but my return is this and my risk is that. Yeah, but it's against your sentiment. Why would I trade a position on a security that's against the sentiment I have for the security? That doesn't make a lot of sense, even if I have a good risk reward profile. That's not my way of trading. I'm not saying it's right. I'm not saying it's wrong. It's just not my way of trading. And as always, I'm open to any counter discussion, whether it comes in the next couple of minutes or whether it comes in via the YouTube comments as well.